Hi, it's Mel Dennis from Domain & Co here for our professional property series. I'm sitting here with Kev from Acknowledge Accounting. Thanks for joining us today, Kev.
Thanks for having us.
We wanted to have a quick chat today around the property structure that you should be looking at, and the names, I guess, in particular, when you go and buy investment properties.
Yeah.
It can be very tricky, I guess, knowing what to do, whether it's an individual, a trust or a company, but just so important to do that planning up front, isn't it? Like old saying, you fail to plan and you're planning to fail.
It's really critical you liaise with your tax accountant or financial advisor to make sure you set up your property purchase correctly from day one. If you don't, it could have drastic consequences for capital gains tax purposes and also for income tax purposes throughout the life of that property. Depending on if the property is negatively geared or positively geared, it can have hugely different outcomes.
Absolutely. So there's three main, structures to pop a property in.
Yeah, there is. Look, and the key things to consider around those property structures that we're going to talk about today. So we're going to talk about company, trust, and individuals. Okay. The key things to consider are asset protection, tax flexibility, an exit strategy, or buying properties with multiple parties or unrelated parties. That's really critical. So we'll cover off on some of those topics.
And knowing some of your costs too, because they can vary depending on your structure. For example, from the State Revenue Office with your land tax, if you've got your property in a company versus an individual, that land tax is almost double, I think, from a company point of view than an individual point of view. Yeah,
so for land tax purposes, there's a trust surcharge. So if you were to acquire a property through, say, a discretionary or family trust, then there is a surcharge rate for land tax.
And so why would you put a property under a trust? It's going to cost you more.
Yeah, so many people purchase property through a trust, mainly for the tax flexibility associated with it, but also a little bit for the asset protection. So some people would invest in the trust because we can have a corporate trustee. Okay, so that gives essentially a corporate veil or shell around the taxpayer so that they don't invest in their own name, and if they're sued, there's no risk because there's a corporate trustee that protects that asset, being the real estate. But then further to that, you not only you get asset protection, you also get some tax flexibility. So a family trust has the ability to distribute on a discretionary basis as to who's going to receive that income. Okay, now a trust works really well when you make a capital gain because you can distribute that income or capital gain to the lowest income earning taxpayer. Whereas if you're making losses, however, though, a trust can't distribute the losses. So the losses are stuck in the trust until you do make positive income. So negatively geared properties don't necessarily work in a trust standalone. However, if you've got other investments or other properties that may be positively geared or some share investments or something within the trust, then that can offset and make it really attractive.
Yeah, great. And another form was to put into your personal name.
That's right.
I guess that would that be the most common?
Look, it's the most cost effective because you don't have to set up a new corporate structure, a trust or a company. So many people and investors tend to buy in their own names or buy them jointly with a spouse. The key things to consider about buying in an individual name are, if it's ever going to be your main residence, then you must buy it or acquire the property in your own individual name because you do not get a main residence exemption for capital gains tax if it's not in your own name. So that's one of the critical things. If there's ever any possibility that it's going to be owned or lived in by yourself as a main residence, that's critical. However, one of the downsides or disadvantages of having property in your own name is that if you are sued, it could be simply that you're riding your bike down the road and you run into someone and they sue you. Well, potentially your personal assets are at risk. So there's no real asset protection around the protection of that real estate property. All right. Also, with individuals, you then got to look at the tax flexibility. So, if an individual owns a property, that individual, you can't change the ownership, or you can change the ownership throughout the period of owning the property. However, you're going to, not for free. There's going to be stamp duty and capital gains tax event for that. So, it's really important that you structure your investment correctly from day one, and that is, if the individual owns the property and they're a high income earner paying top marginal rate of 47%, then any capital gains that they make, they will also pay the top marginal rate less any capital gains tax discounting. So it could hurt where you've got potentially another taxpayer on a lower income. However, that being said, any of the negative gearing associated with that property during the ownership, if it's in a high income earner's individual name, then they're going to get the tax benefits at 47%.
Yeah. But so much things in life can happen, can't it? You go on maternity or paternity leave and you don't have any income to claim it against anymore. So hard to
That's
work out.
That's right. There's no magical formula to do it, but it's making sure you consider all of these alternatives around asset protection, tax flexibility, and the other thing to really consider is around the ownership structure on a title. So if you're going and buying a property with your best mate, then you don't want to be buying it as joint tenants, because if you pass away, then your best mate's just got your share of the property free. Okay, it will pass to them automatically. So
you can't will it or anything.
No. So when you're doing it through unrelated parties, you would do it as tenants in common on the title, and that's really important that you liaise with your accountant and your conveyancer.
It's probably a good, I guess, structure to put it in any case, because then you can't will it. Like, you have a couple that may split up. You all of a sudden aren't in the right structure necessarily anymore.
Yeah, that's right. So generally a husband and wife would buy properties as joint tenants, and then if there were any issues in the future, there's ways around family court and splitting those assets. However, if you're buying property with an unrelated party, we would always suggest that it's bought as tenants in common.
Absolutely. And there was a third structure as well. Yeah,
so companies are another structure you could utilise. Generally, we don't use companies for property acquisitions for mum and dad investors, and the reason for that is companies are not eligible for a 50% CGT discount if you own the property for more than 12 months. So you'll end up paying a flat 30% tax rate on any capital gains, and you'll obviously get the tax benefit on the negative gearing at the 30%. So that's important, but there's obviously costs associated with the setup of a company, around the structural setup, plus then financial statements and an income tax return. So companies are probably a structure we wouldn't recommend unless maybe someone was in the business of property development.
Okay, there's some fantastic tips there.
Yeah.
So if you'd like to know a little bit more in depth around the three structures that we've just spoken about and the pros and cons of each one, click on the link and we'll send you an email pretty much straight away with something that Kev's prepared for you to go through all of that in detail. But obviously Kev's more than happy to chat with you if you'd like to talk about your individual circumstance with regards to buying properties and what structure to pop it into.
Sure.
Yeah, terrific. So thanks again today for joining us, Kev. Really appreciate you going through all the different structures you can buy a property in, and hope that's been some good advice for you guys out there in your next property purchase. Thank you for watching another one of my professional property series interviews. I'd love to see your comments, and please like and subscribe to my social channels on Facebook and YouTube. I welcome any suggestions for new topics too.